Well, hi there. Good morning or good afternoon, depending on what part of the country you are calling in from today. My name is Ginger Bell, and I'd like to welcome you to the Finance of America HELOC product training. And today I will introduce the features and benefits of Finance of America's HELOC product that became available to all Finance of America wholesale customers yesterday on March 16th. So as you're getting logged in there, I'd like to wish you, first of all, a happy St. Patrick's Day or St. Patty's Day, depending on what part of the country you come from. I know for some they don't like that term, so it's a happy St. Patrick's Day. And I will launch you through a couple of things as far as housekeeping, then we're going to get into the information. First of all, there are two different ways you can listen. You can either listen by calling in on your phone, or you can listen onto your computer. And as we have questions today, there are two different ways that you can ask questions. You can either type the question into the chat box, or you can type them into the Q&A box. It's the question and answer box. Both of those work fine. And so you can go ahead and type those in there. I have Mindy Perlmutter, who is the product manager for Finance of America, on the line with me, and she is going to be assisting me with all the answers to the questions. And so, Mindy, thanks for joining. I know you're muted right now, so we'll grab you when we start getting questions. And let's just go ahead and make sure you know how to ask questions. Not that you know how to ask questions. I know you know how to ask questions, but where to ask the questions. And if you can just type in to the Q&A box. Yes. Oh, for those of you who know what the deal is, yes. How's the weather? And, you know, I mean, obviously, we're home now. I'm home. I'm home in Oregon. Looks like I'm going to be here for quite a while. I hope you are safe where you are. And for those of you who now have your children home, you are now able to have an idea as far as what online learning is all about. So if you can just type in the chat box, the Q&A box, have a couple people type in there. Let me know that that you can hear me and you know how to ask questions. That will make me feel assured that it's not just. There we go. Okay, thank you. Awesome. Very good. Thanks, guys. Okay. So those are how you're going to ask questions. I'll tee those up. If I see questions that are coming along, and Mindy too, on a particular area that's relevant to that, then just let me know. I do have a handout for you, the slide deck, and so I'm going to post that up here. I'll post it a couple of other times. I always record our webinars. Our recordings are always posted in the Finance of America online university. So since you're home, that's a great resource to be able to go to and listen to some of the past webinars that we've done. But I'll be posting this in that, and then I'll also send out a link tomorrow that'll have a link to the recording as well as the handout. So if you have somebody that you want to forward it to, who was not able to get on this call, then we can go ahead and do that as well. We have a lot of webinars coming up, and as we know, given the nature of where we are in our world today, we are going to be doing a lot of online training. So we've been fortunate with Finance of America to be doing a lot of webinars for a very long time. So this is not unusual for us, but we do have some very exciting ones coming up. Tomorrow, I'm actually doing a webinar on taking your business virtual. I just decided, since we're kind of in the throes of going virtual, for some of you, you may want to know how to set up a virtual meeting with your borrowers, and that's something that's obviously important because you're not meeting with them face-to-face. So tomorrow, I'm going to be going through how to do that on Zoom, and I'm going to go through step-by-step how to do that, kind of how to write, invitation for that, how to have that dialogue, and if you have staff, on how to have them do it as well. So if you want to register for that, that's going to be tomorrow. And then Tuesday, March 24th, we have an awesome new program under 2X Flex, which is the Asset Qualifier Income Overview. And so you can hop onto that webinar Tuesday, April 7th, under the same product umbrella of our 2X Flex. We have a credit class overview. We're going to be going through credit qualifications for the programs, all the programs under 2X. And then Wednesday, April 15th, which is normally tax day. I don't know if we're actually going to have a tax day this year, but we're going to talk about income qualification overview. So that's what we have going on. And we'll go ahead and get started. And we'll begin with what is a HELOC. So most of you have been around for a long enough time. If you're new to the industry, you may not be familiar with what a HELOC is because it's something that used to be around and now it's coming back, and we're happy to have it back. But HELOC stands for a home equity line of credit. And this is what's called an open and simultaneous second mortgage. So it stands in a second position behind the first mortgage. The rate varies from month to month based on prime and margin, and the margin will be determined based on two different things: the borrower's FICO and the CLTV. So a great feature about FAM's HELOC is that it has an annual cap of 2%, and this protects your borrower from a large prime increase in 1 year. So how can a HELOC help your borrowers? Well, number one, it provides flexibility because they don't have to draw all of it at one time, but they can still have access to it. The second, it avoids mortgage insurance. And then the third, this allows for additional draws. And so again, they don't have to draw on it all at once. They have it available if they should need to draw on it in the future. Borrowers are not required to take a full draw at closing. So that means if they just want to have access to it, they can have access to it. They don't have to take it all out at once. Additional draws are permitted on day 46. So what this means is that there is a 45-day blackout period. And this is in addition to what they already take out in the beginning. So taking out in the beginning, there's a 45-day blackout period, and this was created for a better customer experience. So in these 45 days, the borrower's HELOC will be sold, and it will be sold, and they will receive the information from the borrower, and they'll get information on how to request a second draw. And so that's part of the process. You want to make sure that you're explaining to your borrowers so they get their first draw. And so whatever money they need initially, they're going to draw that. And then after 45 days, so on day 46, they'll get the information, and then they can draw that and draw an additional draw. So they'll have that information on how to do that. Let's talk about avoiding mortgage insurance. So FAM HELOC allows you to go up to a 95% CLTV. And so your borrower can still put less than 20% down and avoid that mortgage insurance. Even if the full line is drawn at closing, your borrower can draw on any available funds within the first 10 years. So how can a HELOC benefit you? And now that we've looked, obviously, at how it can benefit your borrower, let's look at how it can benefit you. It provides for you more options, obviously, to offer to your borrower. You can now get paid on HELOCs instead of brokering them out. And so if you have been doing HELOCs, and there are some smaller banks that offer that, and a lot of times that's just something that maybe that's an option, that you can actually get paid on these instead of having to broker those out. It allows you to follow up at a later date to combine a first and second mortgage. And so now that we've looked at that, let's get to know how the HELOC actually works and some of the program guidelines. So this is a 10-20 HELOC, which means the first 10 years is interest-only payments, and draws can be made, and then the balance is amortized over 20 years. And then you have your line amounts. So your line amounts, the minimum is $10,000. The maximum is $499,999. There's no maximum combined first and second limits. Eligible properties include 1 to 4 units, PUDs, and Fannie Mae warrantable condos. And so if you are looking at that, those are great opportunities there. Occupancy is primary residence, and second homes. So let's look at the qualification. And so if you're looking at the CLTV, the maximum CLTV is 95%. Under credit qualification, the minimum credit score is 680. We do require 3 trade lines, open or closed, and it's evaluated for greater than 12 months. The mortgage history must be 0 times 30 in the most recent 24 months. The maximum DTI is at 38 to 43% and eligible first mortgages. So qualified mortgage loans with the exception of non-QM due to interest only. Now, the payment on the HELOC is going to qualify using the note rate that's fully amortized over the 20 years based on the online limit. For the fully amortizing first mortgage, they're going to qualify using the fully amortized payment. For an interest-only first mortgage, you're going to qualify using the P&I, principal and interest, of fully amortizing the rate over 20 years. So that's how the qualification is going to be used for your payments. This is for a purchase, rate and turn, and cash out refinance as long as it's behind a FAM originated first mortgage. And so this is a simultaneous transaction with a FAM first mortgage and can be used for purchases or for refinances. Under the transactions, as we said, the draws, full draw is not required, but there is that 45-day blackout date for the second draw and any subsequent draws. And that's really for, as we said, the customer experience. So this allows for them to get set up and to be able to have information set to them on how they're going to get that draw, that they can have that. So it's really for them to have a smoother experience, but you want to make sure and explain that. So whatever money they want to get out needs to be on that first draw because there's going to be a 45-day waiting period for that second draw. So you want to make sure and explain that to them. Here's our eligible states, everything except for Texas. And those are only due, obviously, to the requirements that Texas has in place as a state regarding refinances. So the HELOC will follow all Fannie Mae guidelines on anything that's not mentioned in our FAM guidelines. And so what I want to do is point out some differences to you right now. As far as multiple properties, the maximum is 4 properties that are owned, and this is not financed, including the subject property. So it's a matter of 4 properties that are owned. So that's a little bit different. Eligible borrowers, U.S. citizen, resident, permanent resident alien, and first-time home buyers are eligible borrowers. So we went over all of the credit qualification, and here are some requirements for borrowers with major derogatory credit. Major derogatory credit is considered a bankruptcy, a short sale, a deed in lieu, a foreclosure, or modification. So there is no seasoning requirement. Even if you have a foreclosure 8 years ago, your borrower would still need to meet these requirements. And that is a 700 minimum credit score, the loan amount, 200 maximum loan amount, and the DTI and CLTV. So the DTI is 34 over 38%. Maximum CLTV is 90%. So again, these guidelines are only for those that have some type of major derogatory credit, which is, as I said, again, considered a bankruptcy, a short sale, a deed in lieu, a foreclosure, modification. And there's no seasoning on that. So no matter when they had that bankruptcy, no matter when they had that foreclosure, these are the requirements that they have to meet in order to qualify for this program. And then assets, they are required to have a minimum of 12 months in reserves. So here are 3 guidelines that differ from Fannie Mae that we want to talk about. And we're going to get into compensating factors later on in the webinar, but we'll start off with your departing residence. So compensating factor required when using income from their departing residence. And so if they're going to use that income, then what you will need to get is a fully executed lease that includes security deposit and the first month rent check. The second, as far as differences in Fannie Mae guidelines, is for pending sales. If there is a pending sale, then it's a maximum 49.99% DTI. The current and proposed PITIA must be used to qualify, and there must be a fully executed listing agreement or sales contract. And then finally, for any properties that are recently listed for sale, the listing must be removed prior to the application. And it's important to remember that. So you need to have them remove the listing prior to taking the application if the property was recently listed for sale. And then there's a maximum CLTV of 80% if the property was listed in the last 6 months. DTI is a little different as the HELOC looks at the front end ratio. And so the front end ratio of 38%, it's the borrower's housing debt, first, second mortgages, taxes, insurance, and HOA, if it's applicable, and then that's divided by their income. The back end DTI ratio is not to exceed 43%. So that front end ratio, 38%, the back end ratio, 43%, and also there is no payment shock on this product. When calculating your reserves, property tax and insurance, principal and interest, P&I, from both the first and the second mortgage is included. Gift funds and business assets are not permitted to be used towards reserves. Now let's look at income. And to make it a little easier for your borrower with documentation, we will look at the first mortgage income documentation and use that income to qualify. So if you have a conventional Fannie Mae first mortgage, we'll use the same income that DU is requiring to qualify the HELOC. And that's the same with Freddie loans and LPAs. And so if you have a jumbo first mortgage, we will require 2 years full income documentation, which includes 30 days pay stubs, 2 years W-2s, and a verbal VOE. And for a jumbo loan for self-employed borrowers, validated tax transcripts are required, or for borrowers employed by family members, no matter what documentation type that you are following. So those are the income requirements. Now let's look at some of the layered risk and compensating factors. So first of all, payment shock not to be greater than 150%. Your adverse credit, 1 times 30 in the last 12 months. Variable pay exceeds 25% of the total income. Paying down or off debt to qualify. Income from departing residents, gift funds, loan amounts that are greater than 250%, and then use of unsecured debt that's greater than 20% of the annual income. So these are some layered risks and compensating factors that you want to make sure and look at. The amount of compensating factor must match the number of layered risks. So when you're looking at the compensating factor, we divided those into various codes. So you have what your requirement is under the CLTV, under your FICO, under your DTI and your reserves, as well as your payment history based on what the compensating factor is. And so these are areas, if you do have some compensating factors, is to be able to talk to your Finance of America account executive to see what that compensating factor is and what the requirement is. And so Also, Mindy's letting me notice on this, paying off debt is considered and will be considered a layer risk. So compensating factors will be required. And again, as you're getting into this, one of the things that you'll want to do, especially if there are some compensating factors, then to be able to talk to your FAM account executive to go through that and to look at the qualification on that. And I'm going to pull Mindy up here in a second as soon as we get done to answer some of your questions, because I'm seeing a lot of questions coming in, which is great. Keep typing them in there. I'm going to actually have Mindy come in and help us answer some of these questions that you're having when we get to the end. Let's talk about appraisal. A full appraisal is required from the first mortgage. The appraisal must not be greater than 120 days old at the time of the note date. And PIWs, your property inspection waivers, and research are not permitted. So you will need a full appraisal on this. As far as title commitment is from the first mortgage. The line that is less than $250,000, the title commitment is from the first mortgage. If the line is greater than or equal to $250,000, a junior title policy is required, and 24 months chain of title is required. So with that, I want to let you know where the guidelines are available. So we have the product guidelines. It's the bottom of the last page. And I apologize, it looks like that got cut off a little bit. And then the guides are available under Platinum, Resources, Programs, and Guidelines. Then you'll find the HELOCs there. And if you have questions, you can contact your Finance of America account executive. They have access to all of these. And we do have additional marketing material that's available at FAMU. And so if you're not registered on FAMU, you can contact your Finance of America account executive. They can get you registered. It's free. We have a lot of resources that are available there. And so you can go there and listen to any webinar that we've done in the past, and this webinar will be there as well. So now let's get to some questions. And Mindy, I'm going to have you unmute yourself because we're getting a ton of questions, and I'm seeing you're answering some of them. And so I want to go back if I can. And I think we had a question as far as, is this
So we have a question
money
regarding if it's a standalone, if it's only purchase money. The HELOC is a simultaneous transaction. It has to be originated with a FAM first mortgage. The first mortgage has to be QM or non-QM only for interest only. We do allow purchases and refinances.
Right. But it is a simultaneous, so you cannot do a standalone. This is not a standalone HELOC. It has to be done at the same time. It can be for a purchase, it can be for a refi, and it can be for just a rate and term refi as well as a cash out refi.
Yes.
Okay.
Another question came over, and it was a little before we covered part of this about paying off debts. So you can pay off debts, however, that is a layered risk, so you will need to support your file with compensating factors from the chart.
Absolutely.
Okay. Okay. Do you want to say something, Ginger?
No, I was just going to go back to, because I think one of the things when we're looking at compensating factors that I wanted to make sure, and I think we'll get into some of this too when we get into qualifications on those webinars. But, you know, just looking at this, I think it's important when you're doing that. So if you're paying off debt, then that would be considered a compensating factor. So these are the requirements that you would need to meet because that would be there, correct?
Yes. If your file has any of those layered risks, you would need compensating factors. So if you have two layered risks present on your loan, you would need two compensating factors for that.
Okay, very good. So we have another question. Does a 20-year amortization period start after the 10-year interest-only period?
Yes. So it's a 10-year interest-only period where you are able to make draws as well. After that 10 years, it is amortized over a 20-year period.
Okay. And
another question came over about LLPA of the first mortgage. So you would have to refer to your pricing of your first mortgage if there is a HELOC, which would be subordinate financing.
Which kind of goes with it. How much is the rate on the first mortgage affected by the addition of a HELOC? So along the same thing, and just as far as the adds then. So going to the rate sheet, and that's the thing too, when you go through the rate sheet, if you're using the rate sheet to price these out, to make sure and look for those, to be able to price those out. And I would, as you're going through this, I would contact your FAM account executive and go through the pricing on this as you're pricing it out, because they can help you to do that as well. Okay, I'm not seeing any other questions. So
a couple just came over just as you said that. Okay, another question came over regarding reserves. So to calculate your reserves, you're going to look at your P&I for your first, second, and taxes and insurance. So we did have a qualifying page in the very beginning as to what you're going to use as your qualifying payment. So you're going to take your first, your second, taxes, insurance, and HOA if applicable. And that multiplied by the number of months reserves is what you'll need.
Very good. And we have another question from Ethan, if you want to look at that one, Mindy.
Okay. Do you want to pull up the slide on the layered risks, Ginger?
I can go back there, absolutely. I'll just, whoops, lay it there. Okay.
Okay. So they're saying if more than 25% of income is variable, you must have 36% or under DTI. Or if you have 2+ compensating factors, you can go above 36. So if your loan has a layered risk, you can select which compensating factor that meets your loan. So if you have the income is variable pay of greater than 25%, you might look at, listen, I have 6 months reserves and I'm using CF4 as my compensating factor. It doesn't need to meet all of the requirements under the compensating factor. You just need to pick one. If your loan has payment shock greater than 150 and your variable pay exceeding 25%, you need to pick 2. So let's say maybe my borrower has owned a home for more than 5 years and I have additional reserves. That would meet the compensating factors for the layered risk. Okay, another question came over regarding compensation. Compensation for this product is 25 basis points with a max of $1,000, and it's off of the line limit.
Okay, so the maximum, and so the question then becomes, because as brokers, there is whatever the agreement is, and so you know, it's going to be tied into your pricing. So I think that's the question that comes up as far as pricing, right?
So Kyle, do you want to discuss how the HELOC product is for the compensation type?
Yeah, so because the HELOC is an open-ended line of credit, it's not subject to the same rules as like the first mortgages and like the comp plans that we set up. And so these just have their own separate comp plan that, as Mindy said, it's 25 basis points paid off of the line amount. So even if the borrower takes no draw at closing, the broker will still get paid the 25 basis points with a cap of $1,000.
Do you want to also explain when you look at OB about lender paid comp, borrower paid comp, and what happens, what they'll see there?
Sorry, yes. So when you actually price the loan, this is a little bit confusing, but when you actually price the loan in Optimal Blue, you will price it as borrower paid compensation. If you were to try to price it as lender paid compensation, you will get an ineligible message. And the reason for that is just because Optimal Blue will think it's trying to apply your normal first mortgage comp plan. And so since we pay comp on this one a little bit differently, they'll always price and lock it as borrower paid, but it will still be lender paid. We will still disperse that compensation at closing.
Thank you.
Very good. And we've had a question as far as some of you are hopping on late. And I know, you know, you're busy right now and things are going on. So we do have a recording of this I will send out a copy of the recording that will go out to you tomorrow, along with a link to the slides. And if you do have any questions at all, you can always contact your Finance of America account executive. They are available to help you, whether it's pricing or compensation or qualifying or compensating factors, all of those different things. Okay, and I'm not seeing...
There's one more question that came over regarding compensation. So comp for HELOC is 25 basis points with a maximum of 1,000 of the line limit.
Right. So what we'll make sure and do is to add some of those in there as well.
There is also an FAQ that is posted along with the guidelines that will give you some of these answers to your questions.
Very good.
And the compensation is included.
So look for that. And then we have upcoming webinars that are coming up. So make sure and register for those. You can register at famtpo.com. Tomorrow we have the Taking Your Business Virtual. And then next week on Tuesday, we have the Asset Qualifier Income Overview. Mindy will be joining me for that. And then we have April Credit Class Overview, as well as our Income Qualification Overview. So I'm not seeing any other questions. I want to thank all of you for hopping on. Mindy and Kyle, thanks for joining me. Always love having you guys on here, and make sure and contact your FAM account executive, and stay safe, stay healthy, and wash your hands.
Thank you, Ginger.
Thanks, guys.
Ginger.
Okay, bye.